Number 2. Goods were sold on credit to a debtor, 10,125 Rand. A profit margin of 35% on the cost price is maintained throughout. So in order to complete transaction number 2, we first need to calculate the cost price. Now there is a formula involved. We know that cost price is 100 divided by 100 plus your markup percentage times your selling price. So in this transaction, it's 100 divided by 100 plus 35 times your selling price of 10,125 Rand, and that gives you a cost price of 7,500 Rand. Now we have our two amounts. We've got our selling price of 10,125 Rand, and we've got our cost price of 7,500 Rand. Step 1 is to determine the 4 ledger accounts involved. So when we look at our selling price, our 2 ledger accounts will be sales and debtors control. When we look at our cost price, our 2 ledger accounts will be cost of sales and inventory. The next step is to classify each ledger account. Sales we know is an owner's equity. Debtors control we know is an asset. Cost of sales is also an owner's equity, and inventory is also an asset. But let's just first do the selling price part. So, what effect does sales have on owner's equity? Well, when the business sells stock, it has a positive effect on owner's equity. Debtors control will increase, as the debtor's debt will increase when he buys more stock on credit. Let's complete the selling price part of this transaction onto our worksheet. So the journal involved is your debtor's journal, and your source document is a duplicate credit sales invoice, which you can abbreviate as DCSI. So the first 2 lines will be for the selling price. So debtors control was debited, sales account was credited. We said the sales will have a positive effect on owner's equity of 10,125, and we said that the debtors control will increase with the selling price of 10,125. Because he is buying more on credit, so his account balance goes up. In other words, the debtor now owes us even more money on credit that he bought. Let's look at the second part of this transaction, which is our cost price. For our cost price, we determined that your 2 accounts is your cost of sales account and your inventory account. So let's quickly classify each account. We know that cost of sales is an owner's equity, and we know that inventory is an asset. Cost of sales is an expense, and we know expenses has a negative effect on owner's equity. Inventory is an asset. Because we are selling inventory, our inventory stock levels are going down, so it will also have a negative effect. So let's put this transaction now onto our worksheet using the cost price of 7,500 Rand. So cost of sales will be debited, inventory will be credited, owner's equity will decrease with a cost price of 7,500 Rand, and your assets will decrease with a cost price of 7,500 Rand, because you are selling your stock on credit to a debtor, so your stock levels will decrease. Number 3. An electronic transfer of 9,025 Rand was received from a debtor regarding settlement of an account after 5% discount was allowed. So first of all, this transaction requires a calculation. We need to calculate the discount allowed. The amount on the check of 9,025 Rand is the amount after the discount. So the formula will be The amount on the check of 9,025 times 5%, because we know we offered a 5% discount, but not over 100, but only over 95, because we need to work backwards. So the discount allowed is 475 Rand. The next step is to determine the ledger accounts involved. When a debtor settles his debt, the two accounts involved will be bank and debtors control. Both of these accounts will be classified as an asset. Our debtors control will decrease with the amount of 9025, and our bank account will increase with the amount of 9025. So let's quickly record this transaction into our first part of our workbook. The journal, because we're receiving money, will be our cash receipts journal. The source document is our bank statement. The account debited is our bank account. The account credited is our debtors control account. We said they're both an asset, so it will be 9025 on the debit side as well as 9025 in the credit side. But then this transaction had a second part to it. Remember, we allowed this debtor a discount. So the two ledger accounts will be discount allowed and debtors control. Discount allowed is classified as an owner's equity, and it is an expense to the business, so it will have a negative effect. Debtors control is an asset, and discount allowed decreases the debtor's debt. Let's record this onto our answer sheet. So the account debited is discount allowed. The account credited is debtors control. $475 in the debit column and $475 in the credit column of assets. Number 4, stationery was bought on credit for 12,000 Rand. Step 1, let's determine our two ledger accounts. The first one will be stationery, and the second ledger account will be creditors control. Step 2, let's classify these two ledger accounts. Stationery is an owner's equity account. Creditors control is a liability account. Because we are buying stationery on credit, our liability will increase. And stationery is an expense account, and expenses have a negative effect on owner's equity. And the amount is 12,000 Rand. So let's record all of this onto our answer sheet. Our journal will be our creditors journal. Our source document will be our credit purchase invoice. The account debited was stationery. The account credited was creditors control. Owner's equity decreases by 12,000 Rand. And our liability increases by 12,000 Rand. Number 5, an electronic fund transfer for 3,500 Rand was made to a creditor as settlement of an account of 3,800 Rand. This transaction first involves a calculation because we are settling our debt with our creditors in full, so our creditors are giving us a discount known as discount received. So in order to calculate the discount received, we take our full debt of 3,800 Rand, we minus the payment that we are making to them of 3,500 Rand, and that difference is our discount received of 300 Rand. So step 1, let's determine the ledger accounts involved. Once again, this will have two transactions. We're first going to record the payment that we made towards our creditors, and then we will record the discount received for paying in full. So let's look at the first part. The first two ledger accounts will be creditors control and bank. Creditors control we will classify as being a liability, and bank is an asset. When we pay our debt towards our creditors, our debt will go down, so it will decrease our liability. And because we are taking money out of our bank account, our bank will also decrease. So let's put this transaction onto our worksheet. So 5.1, our source document will be our electronic funds transfer, and the journal is our cash payments journal because we are making a payment. The account debited was creditors control, and the account credited was bank, and the amount is 3,500 Rand. Our liability decreases, so it is debited, and our bank account decreases, so it is credited. Let's record the second part. Now we have to record the discount received. So our two ledger accounts involved will be creditors control and discount received. Creditors control is a liability, discount received is an owner's equity, but it is an income owner's equity, so it will have a positive effect on our owner's equity. So the 300 Rand will have a positive effect, which means it will be credited. Our creditors control liability, we are receiving a discount for paying in full, so our creditors control is also being reduced by 300. So it will have a negative effect on our liability. So let's record this onto our worksheet. So the account debited is creditors control. The account credited is discount received. 300 Rand on the credit side of equity and 300 Rand on the debit side of liabilities. Number 6. The discount allowed on the electronic payment previously received from a debtor, see number 3. Remember number 3? We got given a 475 Rand discount. A debtor settled in full. This discount must now get cancelled since the payment was made late. Our two ledger accounts will be debtors control and discount allowed. Debtors control is an asset. Discount allowed is an owner's equity. Our debtors control's debt will now go up again because we have to cancel the discount, so he now owes us that money again, and discount allowed will be credited. Let's record this onto our answer sheet. So the journal will be our general journal. The source document is our journal voucher, abbreviated as JV. The account debited was debtors control. The account credited was discount allowed. 475 Rand on the debit side of assets and 475 Rand on the credit side of owner's equity. Number 7. 50,000 Rand was invested at ABSA in a fixed deposit at an interest rate of 4.5%. The two ledger accounts will be fixed deposit ABSA and bank. They are both assets. So let's record this on our answer sheet. The journal involved is CPJ. The source document is EFT. The account to be debited is fixed deposit ABSA. The account to be credited is bank. And it will, since they're both assets, it will be plus 50,000 in the debit column of assets, as well as 50,000 in the credit column of assets. 8. A previous fixed deposit at FNB has matured. The original deposit was 25,000 Rand. An electronic transfer directly into the current bank account of the entity was received from FNB for the deposit and the interest for the 3 months at a rate of 4%. So once again, this transaction involves 2 steps. Firstly, we've got to record the fixed deposit that is matured, and then we will record the interest that we received on this fixed deposit. So let's just do part 1. The fixed deposit that matured, our 2 accounts will be bank and fixed deposit FNB. Both of these accounts are assets. Our bank account will increase and our fixed deposit will decrease since it has matured. So let's record this onto our answer sheet. 8.1, our journal is our cash receipts journal. Our source document is our bank statement. The account debited is bank. The account credited is fixed deposit FNB. Since they are both assets, it will be 25,000 in the debit of assets and 25,000 on the credit side of assets. The second part of this transaction is now the interest on fixed deposit that we need to calculate. The 2 ledger accounts will be bank and interest on fixed deposit. Bank is an asset. Interest on fixed deposit is an owner's equity. Bank will have a positive effect, and our interest on fixed deposit will also have a positive effect on owner's equity. So let's record this. Account debited is bank. Account credited is interest on fixed deposit. Owner's equity will have a positive effect of 250 Rand, and our bank will have a positive effect of 250 Rand. Number 9, the bank statement reflects a credit entry in respect of interest on our current account, 760 Rand. The 2 ledger accounts will be our bank account and our interest on current account. Our bank account is an asset. Interest on current account is an owner's equity. We're receiving interest, so it will have a positive effect on our current account for our owner's equity, and our bank will also have a positive effect as we are receiving money, so our bank balance will go up. So let's put this into our answer sheet. The journal involved, because we're receiving money, is a cash receipts journal. The source document is our bank statement. Account debited was bank. Account credited is interest on current account. Our owner's equity has a positive effect of 760 Rand, and our assets has a positive effect of 760 Rand in our bank account. 10. A loan of 80,000 Rand was obtained from Nedbank at an interest rate of 9%. So our 2 ledger accounts involved will be bank and loan Nedbank. Bank is an asset. Loan account is a liability. Since we are taking out a loan, our liability will increase. And since we are receiving the money in our bank account, our cash flow in our bank will also increase. So let's put this into our answer sheet. The journal involved is our cash receipts journal because we are receiving money in the form of a loan. Our source document is our bank statement. The account debited is bank. The account credited is loan net bank, 80,000 in the credit column of liabilities, and 80,000 in the debit column of assets. Number 11. Make an electronic transfer for goods purchased, 16,000 Rand. So your two ledger accounts will be inventory and bank. This time you're buying stock for cash. Both of these accounts are classified as assets. You are taking money out of your bank account. Your bank is decreasing to buy stock, so your stock levels is increasing to the value of 16,000 Rand. So let's record this. Our subsidiary journal will be our CPJ because of the cash payments that we're making. Our source document is an EFT. The account debited was inventory. The account credited was our bank account. They are both assets, so it will be plus and minus 16,000 in the debit and credit column of assets.